do this for in the last semester. I do this every semester. I need somebody who can remind me to push the recording button, because if I don't push the recording button, there will be no recording for in the Microsoft team. Can I ask Bailo? Can you do that, Bailo? That help me to remind every classes.
Okay,
All right. Okay.
okay, inshallah, I'll do it.
Okay. Right. That's good. Right. Okay. Let's start with our first class. Yeah. Brother Muhammad, are you sorting out there? Are you okay? Maybe you can mute yourself first, so that there will be no the audio disturbance. Right. So okay. Yeah, I think you need to mute. You can unmute later when you want to speak up. Yeah. All right. Let me mute. Oh, I cannot mute. Okay. All right. Okay. Bismillah wassalatu wassalamu ala rasulillah. So this will be our first session. Oh, again, I'm hearing my own voice. Okay, let me mute. All right. Okay. All right. So the first lecture that we will look at the three main contents. Right. The first one, we try to understand what are the purpose for studying money and banking. Right. The focus here not so much on your personal interests. Right. Yeah. Let me try to mute again because I'm hearing my own voice. Okay. All right. So let me come again. So we try to understand what are the purpose of for us to understand how the markets works in our ecosystem, right? I cannot speak. Mahmoud, can you mute yourself?
You said?
Can you mute? It keep unmuting that. Okay. All right. All right. It's okay. It's better now. Right. So come back about the purpose of studying the markets, the financial markets, and also how money works, right? So what I was trying to say just now is that it's not so much on about our personal interests. I mean, why you taking this course and whatnot, but rather we're going to visit the reason why economists, why policymakers are interested to find out about this and explore the relationship between the financial development, the financial market development, and how it relates to the economic welfare and economic development, right? So that's the purpose of visiting this discussion, right? And then the second part of our discussion later, we're going to look at the six components of the financial system. What are the market players that existed in the financial markets, right? Together, they make a whole ecosystem, right? In order to make the market functionings effectively, right? You will see that later, shortly, right? And then before we end today, we're going to look at the 5 core principles of money and banking. This is very important because even like the current discussion among economists and policy makers, they use this principle in order to study the economic event, to study how the financial market behave, right? So at the end, it relates to these 5 core principles of money and banking, right? It's very common in many banking textbook, right? The one that I suggested to you, there are 2, right? The main one and also the secondary one, right? So both of them are discussing about this principle. We will look at this principle in very detail shortly, right? So again, why should we study money and banking at the first place, right? Let's try to put ourselves into the perspective of economists and also the policymakers in the money and financial markets, right? So let me present to, can you see the screen clearly? I hope it's clear. Let me.
Yes,
So
clear.
all right, so today I hope I can use my pen. Oh, it's working, right? I had a problem yesterday using the pen. So now it's working, so it's good, right? So let me present to you the finding of the research conducted by Simon Hall, right? Simon Hall is basically a researcher. He was attached to Bank of England previously, late, I think in 2000, I think his study published in 2009, but later on, I think he moved to other institution, right? So what he was trying to achieve is basically he want to find out how the financial market around the globe are interconnected with each other, right? Especially before what happened during the crisis in 2008. Sorry, let me, okay. It's not working now. All right, before the financial crisis, 2008, 2009, global financial crisis. I think you heard this before, right? You pretty much understood what happened in the market at that time, right? So using the data that he collected, then he tried to map this out in terms of this graph, right? So back then, before we had this concept of globalization, right? Before we have the concept of market liberalization, right? Liberalization means here that every country was opening up their economy so that many foreign or many outsiders can join the market and then do their trades and also participate in their financial markets, right? So back then in 1980s, so using the data that he had, so he mapped out the interlinkages between these markets. So it looks something like this, right? So the economic size of that time of the markets that time are relatively small, if smaller, right? Because they are basically a closed economy, right? Meaning that they are self-sustaining within their own country, right? There were not much participation from the foreigners, from the foreign lenders and whatnot, right? So they are basically operating within their borders, right? Although saying that they had some trade and also relation in financial relation with other nation as well, right? So it looked like quite can be digested here, right? We can still imagine how the markets look like here on the in the first picture here, right? And then after that, this concept of globalization came about, right? And then the financial liberalization policies was introduced by the government. Basically, they believe that by having more participation from outsiders, from the foreigners, we can grow the economy better, right? We can enlarge the size of financial markets altogether, right? So many countries will start opening their markets from many foreign participants, right? And then true enough, right? They get the benefit that they're trying to achieve, right? The economy is starting to get larger, right? You see the earlier adopters of this policy, like the US and those European countries, right? They started to see their markets become larger and larger over time. And then one thing that you should also notice here is that the interconnection between markets is getting more complex, right? More dynamic in that sense, right? You see it looked like a very unorganized or unstructured spider web here, right? It's very difficult for you to explain the linkages now, right? It's getting more difficult here, right? Right before we had the worst or the nightmare during the 2008 and 2009 when we had when we see the financial markets was totally collapsed, right? So let's say if you have an opportunity here, right? I mean, if you have an opportunity to extend the study by Salmon Hall, right? So what would you imagine happen in 2000, let's say 2010, right? Anyone like want to, present their imagination? What happened at that time, 2010? How the markets look like at that time? Anyone? Sundus, you wanna say something? Or maybe Mahmoud. Mahmoud, you are new, right? So let's hear from you. What will you imagine that time, 2010? Or am I talking to myself? Or can you hear my voice? Am I muted?
Yeah,
Assalamualaikum, Prof.
yeah,
It's clear.
can have you.
Oh, all right. Okay. So Nias, what do you think that what happened in 2010?
Actually, what happened in 2008, 2009, 2010 was that a recession that is due to the fact that the American banks basically they gave loans for house building indiscriminately, and at the end they couldn't get the return of that money. So there was a serious recession at that time, inflation as well, and serious financial crisis, in fact.
Right. So you can imagine that the bond was broken, right? I mean, suddenly there's a shock in demand, right? Because people are basically stuck with having a bad impact on their investment. Am I right?
Yes,
So
exactly.
you can imagine that the spider web was just crash out, right? At that time, right?
Yes.
But one thing that we should notice about financial market is that they have this kind of what we commonly term as a muscle memory, right? So let's say, for example, you work out in the gym, right? You work out in the gym, and then you didn't go for the gym for let's say months, right? And then you started to go a gym again, right? And then your muscle is big. At that time you lose the momentum, right? But your muscle actually can pick up things very quickly. So it's the same happen in to our financial markets, right? Although the market collapsed, right? And then some of the financial institution was saved by the government, you see, but some were not saved by the government, right? So after that, you will see that again, what we call as this so-called as the muscle memory. So the market will start building up again, right? Based on experience that they have before, even before for the financial crisis, right? And then now what we have in the digital age, right? With the presence of many this so-called as digital financial instrument, right? People are connecting to one another in a very different way, right? So it's very much easier for you with the presence of, let's say, mobile banking, right? You have and now they have like even even if you want to open an account at a bank, you don't have to go to the branch, physical branch, right? You can do it online. Everything is online now, right? Everything is digital. Everything is in the online platform, right? So you can imagine what happened now, right? Let's say you have the second opportunity again, right? To extend the study by Salmon Hall, right? So what the spider web will look now, right? So let me ask another person, like, let me hear from, let's try you, Mahmoud, right? Try again. you were here just now, right? can you tell me what you imagine how the financial markets, the global financial markets network will look now at the present day? And you hear? No? All right, let me hear from Sundus. Sundus, you hear?
Yes, doctor.
Right. So what we will see now, how the financial market is interconnecting to one another at the moment.
It will be different. I think everything will go down.
Everything will go down again in the digital age that we have now. Right. So let me tell you what I think my imagination, right? How we can perceive how the markets works today, right? So I think what is my pen? It's not right. So the market will look like everything like this. Even I think it's very difficult for you to predict, right? Because of the nature that it has now, right? Banks will just go digital, right? So everyone basically in terms of the news as well, in terms of dissemination of financial information, people have more access to financial market nowadays through this digital platform, right? So you can imagine, let's say, for example, I'm an investor in Malaysia, right? So let's say if I want to invest on some investment in the US, right? I don't have to be physically there compared to previously. Back then, I'm talking about 20 to 30 years ago, right? I can simply use like any apps that allow me to place my money somewhere, right, to access the investment, right? So you'll be also exposed not in the different way of investing, but also in different type of financial asset, right? We will look at this later on, right? So try to speak up. Otherwise, I'll be speaking to myself, right? So you can contribute to the discussion where just stop me anytime, all right? So one thing that we can learn from the previous, so you get the point I'm trying to say here is that the financial market is very interdependent to one another, right? So that's the conclusion that we are trying to make here, right? So and another thing that we can, one thing that we can learn from the previous financial crisis in 2008 and 2009 is that financial stability is very important, right? Because it relates to the welfare, the well-being of the society, right? The case in US is very much clear and case in point, I would say, right? You see the collapse of Lehman Brothers has resulted in the huge decrease in employment in very short time, right? So the unemployment, sorry, not unemployment, the GDP was decreased tremendously at that time in a very short period of time. And then we will see the unemployment was picking up at a very short time as well, from 5 to 10%, right? So usually for unemployment to reach from 5 to 10%, it will take several years, right, in normal times, right? So what happened during the crisis? This was just like the whole different situation, right? When people start losing unemployment, when people start using their jobs and their works, what happened is that people are committing suicides, right? That's a very tragic happened at that time. And then you will see also the crime rate was shooting up, right? People barely have money to survive at that time, and not just in the US, because remember I mentioned to you what happened before.
Sorry, doctor.
Yeah.
I have a question. Like, what was the cause of that crisis?
What was cause of that crisis? There's a very long story. Let me see where I can tell. Okay, right. Let me tell you now. I was thinking that maybe I can have another, right? So remember, like you have in finance or in the economy as a whole, you have two sorry, where is it working? All right, okay, let me try again. All right, so you have two types of markets, right? So one we call it as the real sector, right? And what we are discussing now today, what our focus is on, is basically the financial sector, right? So what happened during the global financial crisis 2008 and 2009 is basically it started from the housing market in the US at that time, right? It was during that time the people in the US start to buying their own house, right? Because, and then you will see there's a lot of development, residential development at that time. Right? Even you are, if you are average normal workers, because banks have basically have a high liquidity at that time, you are able to apply yourself a mortgage at that time, right? So that you can use the mortgage to buy your own house, even you are just average normal workers, right? So some of them actually buy more than one, right? Because there is excess liquidity at that time. Before, I'm talking before 2008 and 2009, right? Because there's a lot of liquidity at that time, right? So the market was booming up there. Housing market was booming up, right? So what happened in people in the financial markets, right? At that time, all the asset managers and all the bankers was thinking that how we can make more money out of this residential markets, right? So basically, people are applying mortgage, right? So you have banks here, right? Banks that provide the mortgage to those people, right? Who need to buy the house, right? And let me try to move up a bit, right? Okay. So what, and then what they do this household is that they basically need to do a repayment, right? Because they have acquired the mortgage, then they have to do the periodic repayment, like every month and every year. They have to pay what they have borrowed from the banks, right? So this asset managers and also the bankers was thinking that maybe we can create a financial product here, right? Where the return will be from the repayments of these mortgages, right? So we will create like a product. They say that they will create a product, right? So, and then you have an investor, right, who purchased the product here, right? This investor is basically looking for returns, right? Okay. So this product, what they call as the collateralized, sorry for my bad handwriting, debt obligation, right? Meaning that, oh, sorry. Right. So meaning that this is basically an investment instrument, like the underlying asset that was generating the money for the instrument that will be channeled as a return to the investor here is basically the repayment from the borrowers in the housing markets in the US at that time, right? So these CDOs have become quite profitable, right? Because who at that time they were thinking who wouldn't pay their mortgage, right? Everyone is paying their mortgage every month, right? And then it's basically like become like what we call as the custom at that time. Like people will not miss their repayment because they don't want basically to lose the house, right? When these CDOs become very profitable at that time, so these investors was asking like, can you issue me more, right? More and more financial instrument like this, right? And then what did these bankers and asset managers was they are also getting a profit of it, right? They're getting the fees, right? The small fees, although it's small, but when you're dealing with at that time, I think this worth like trillion, right? Trillion worth of investment. Even if you earn 0.01% at that time, you could earn 1 million already at that time as an asset manager, right? So they were looking forward to have this more instrument like this, right? So at that time they become greedy in nature, right? So they start to having another synthetic products like CDOs as well, right? That return will generate from another CDOs. So if you can imagine, it become a multiple layers of financial instrument that depends on each other, right? So meaning that if one fail, and then the others will the same thing will happen to others as well, right? So that basically the environment at that time, right? People are become very motivated with the returns, right? They want to generate more returns, right? So hence, so what happened here? Banks that issue. Sorry, I'm trying to move. Okay, so what did these commercial banks or the personal banks bankers here? Basically, they issue more mortgages, right? I think I mentioned to you about the movie that you can watch. What was it called? It's not Margin Call. I think you can refer to one of in my previous lecture. It's one of the movie very peculiar that I noticed that even the borrower, the household, can apply the mortgage loan application by using his dog's name to that extent, meaning that there are too much liquidity available at that time, right? Even you can falsify the document and you still get the mortgage approved, right? You can own so many property at that time, right? So people are just keep borrowing money, even even in the actuality, right? I mean, they don't have that capacity and they don't have the access of money to repay the debt obligation, right? So when this markets, this real estate markets was having a difficulty in terms of getting the repayment at this time, right? People are just become default at that time. They couldn't service their mortgages, right? They become and then they had to sell their houses and everything, right? So what happened here, because I mentioned earlier, what actually generate the return here is basically the repayment, right, from the mortgages, right? So once you have a problem in the real estate here, it will trigger the effects in the financial sectors as well, right? So those people who bought these CDOs and other related financial instrument were hit by these sudden shocks in terms of getting the returns, right? So hence they will create a shock in their demand, right? So people are suddenly don't have enough money to spend, right? And then you have to remember that these investors was not the one from US only, right? There are many, they are from many other countries as well, right? So that's how you can feel if you felt the effect of global financial crisis in 2008 and 2009. Although not so much here in Malaysia, right? Only certain people who invested in or have an exposure to the US financial sector and the mortgage sector was affected at that time. I think in Malaysia here we were more badly affected due to the Asian financial crisis in 1997 at that time. That was worse than, I think, global financial crisis, right? But when you talk about the global sphere, All right. Yeah. I think the global financial crisis 2008 and 2009 is basically the worst so far that we have, right? Apart from the Great Depression that we have in 1970s, right? So is that clear for you? I'm trying to. I hope I didn't take so much. Is that clear, Bailo, for you? How
Yeah,
it
yeah,
works?
it's clear. It's clear.
All right. Okay. All right.
Yeah, it's a bit complicated, but
It's
I
very.
think I got the idea.
Yeah. Try to watch the movie, or you can read the news about that at that time. Right? So you can
Okay, inshallah.
look it up, right? And then if you read the recent news about this giant property company in China recently by the name of Evergrande, right? Evergrande is a multi-billion company, although they are just operating in China, right? But they basically dominated the residential markets there, right? They were talking about. You can see here that they have more than 200,000 employee at that time, and also they basically contributed a lot to the employment, right, by creating the jobs in China, right? So what happened recently with Evergrande is that they were putting in the situation where they could go into a default, right? Because basically they were borrowing money, right? Because by operating a property company, right? I mean, as developers for residential or public infrastructure, right? So your money stream, your income stream shouldn't be a problem, right? Banks would be happy to lend you money because you have basically a good stream of cash coming in that you can use to serve your financing or your loan, right? Should be no problem for you to repay your loans, right? So what happened to Evergrande is that they keep borrowing the money, right? They borrow from banks, they borrow from the public by issuing bonds. They also if you look at how they borrow, you think that they quite it's quite extreme in terms of the numbers that they borrowed, right? So what happened recently is that Chinese government has introduced a policy where they try to limit the local debts, right? So they put a restriction saying that if you're a local company, that you can only borrow certain amount of money to certain percentage out of your total asset, right? So now Evergrande was stuck, right? Because they need to keep borrow to borrow the money in order to finance the existing bonds that they have, right? The existing debts that they have. Right, and then at that time was the country was badly hit by the COVID-19, right? So people are suddenly stop buying properties, right? Because they need the cash and the money for their own survival at that time. So now it seems like what happened here is that we tend to make the same mistake again and again because of what? Because of our greed, our own greed, right? Because you have to remember one thing is that financial market is a human-driven kind of mechanism here, right? Because it's a nature of a human that we tend to keep the same mistake, right? Because I think that's how our creator described us, right? As a human being, right? We do sins, and then we repent, and then we do the same thing again over and over again. The same thing to the financial markets, right? So and on the second note is that you should be able to get an idea is that financial market is no strange, right? It's basically a human-driven system, right? You will see that the behavior, how the financial markets or financial institution behave, same like human, right? Because basically they were driven by human, right? All those asset managers, all those banking institution, bankers and whatnot. So they tend to have that kind of behavior that tend to lead to the financial instability, right? So that we don't want that to happen in the next couple of years, right? Where we are recovering now from the COVID-19, right? So that was just basically an introduction to our discovery of how the financial markets works, right? And what I would like to encourage here in terms of how we're going through our discussion is basically we need to consider another new alternative way of how we can perceive or how we can give a direction how the financial market should function in the future, right? So that's the job for you as a student, right? And myself as well, because I'm considering quite junior, right? So we need to think about the new way of thinking, economic way of thinking, right? How the financial market should behave in the future, right? Is it necessary for us just to pursue the growth, right? Is it like too high growth in the market? Is it good for us, right? So that's the kind of, because previously that was perceived so, right? By the previous economists or by previous policymakers, right? What they're trying to achieve is like they look at how to expand the market, become bigger and bigger and bigger, right? So, but what we should question here now is is it necessarily good for us, right? Because we have seen like so many issues that we are facing now in terms of the climate change, right? We have a high incidence of poverty, inequality, right? So by achieving those growth in the financial market, are we getting better in this in terms of improving the welfare of the society, right? You should think of that, right? As the 21st or 22nd century of economic students, right? And I would like to suggest to you to have this habit of reading at least one or two articles from financial magazine, like I mentioned to you earlier. You can read from Financial Times, you can read The Economist. Right? By having that kind of reading, it will shape your view or your worldview on how the financial market should operate. Right? But it's not necessary that you should agree. Right? That's what I was looking. I will look from your article review. Right? I want to hear from you in terms of how you're thinking, like how should the market behave, right? Right, we still have a couple of minutes to go, right? Anyone have things that you want to add here? Any questions so far in terms of our approach, right?
Well, Doctor, I was really surprised to learn about the Evergrande case. So, what is the latest situation? How they are handling?
Yeah.
What is the latest?
Yeah, Evergrande. Like I mean, I didn't follow. I mean, for the past couple of weeks because I was reading about the war crisis between Russia and Ukraine. Yeah, right. Yeah. So that like for the Evergrande, I think at that time the Chinese government was still deciding whether they wanted to save the Evergrande or not, right? Because if they didn't save the Evergrande, you will see the bad implication will have to their own people, right? Right. Then people was asking to the economists, right? I mean, what will you predict? What will happen if this big giant company collapse, right? Will they trigger another financial crisis, right? Because people were afraid of what happened in global financial crisis, which is related to similar industry, which is the property and residential sectors, right? But most of them will see that this kind of cases basically are two different, were in a two different situation, right? because what happened in global financial crisis, because of you were having too much synthetic financial instrument, right? Where there's no much underlying economic activities at that time, right? It's just like artificial products, financial product, you created to, to pursue your profits at that time, right? But when you're talking about Evergrande is basically a real case situation, right? Where this company need money to continue their business operation, which is happen in the real economic sectors, right? So it's basically two different things, right? So people say that it will not trigger another crisis, of course, right? But you have to differentiate what is between crisis and just a normal shocks, right? Because when you talk about crisis, is basically the collapse of the entire system, that what happened in 2008 and 2009, where you require the government to come in to save you and to save the institution using the public funds, right? So that how we define crisis, right? But will it lead to shocks? We probably, right? We probably see that if Evergrande will not be safe, we will probably see there's a sudden shocks in terms of people spending, right? Because basically they are exposed to this company, they are workers of this company, they are buying the shares of the company. If the company suddenly collapse, of course people will be affected, right? Whether it trigger a crisis, that's another discussion all over, right?
Right. Thank you.
Okay, right. So let me try to catch up a bit before we go to a break, right? So the second part of our discussion will revolve around the important components of financial markets or financial system per se, right? So we're going to look at this very brief at the surface level, right? Because basically in the following chapters in the next, yep.
Yes. What type of financial crisis did that group that makes them? What type of financial crisis is that makes them borrow that huge amount of money? What type of financial crisis make them borrow that huge amount of money?
What type of financial crisis that makes them borrow the amount of money?
Yes.
Yeah, I'm trying to understand your question here. Can you rephrase what your question again? Come again.
The question here is it not that the reason why they borrowed the money is because of financial crisis, right?
You mean are you asking about the global financial crisis?
Yes,
Evergrande.
Yes.
Yeah, the Evergrande was borrowing money because they have the underlying investment project that they need cash liquidity, right? Because they are building high-rises apartment that need huge amount of money, right? Of course, you cannot generate that capital internally from your cash flow and whatnot, because there will be a delay, right? Yes. Because where you build a home, it's not like next week you will get it done, right? You have to wait for several years, right? So you need that. This company need that kind of liquidity, right? But the problem here is that because they are too big, right? They have multiple ongoing project. Then they need more cash, right? So that's the reason why they're borrowing the money, right?
Okay. Yes. Thank you.
Yeah. So you see the reason, the different purpose of between Evergrande and those in financial market in 2008 and 2009, right? They're borrowing money for two different purposes.
Yes,
right?
yes, I get it.
Okay, all right. So these six parts of financial markets will make together as a financial ecosystem where they need each other, right? You will see the interconnection, and you will see that they play a different role among each other, right? You will see that they are basically complement to each other, right? In order for us to have our daily financial transaction, right? So maybe as a common people on the street, right, in the street, you don't quite realize this, right? But unless you are very interested on financial markets or banking studies, then you will read through and you read more about this, and then you can see how people explain the interconnection between these parts of the financial markets, right? So as I mentioned earlier, we will go through each of them very detailed in the different topics coming in next several weeks, right, before you meet Madam Zaria and another lecture. But for the sake of our discussion today, we will just briefly look at them, like individually, right? So the components that you have here is basically the money, financial instruments. They are basically serving two different purposes, right? Sorry, let me use. All right, sorry. Why it's not? Oh, never mind. All right. And then you will see where this financial instrument was traded in the different type of financial markets, and then who basically run the financial markets is basically the institutions, right? And then you need a governing bodies, like a supervisory bodies that will oversee the stability of the markets. You have a different standard setting of body, right? And then you also have the regulatory bodies, basically those central banks, right? So one thing about let's look at the first one about money. One thing that I would like to emphasize here is that the money has has evolved over time in terms of their form, right? I'm talking about the physical form, right? Back then, before the introduction of money in the form of commodity, we used to trade. Our like long ancestor before, they basically trade using a barter system. I think you are very clear. I mean, you know what this barter system looks like, right? Meaning that people exchanging goods and items, right, among each other, right? Without having a common denomination or common form of money or physical money at that time, right? And then as soon as people are trading cross borders, right? People go abroad to trade their goods and services, and then they realize that they need something to carry with them to be able to transact with other people in other places, right? So hence they start to find a common commodity that they can be deemed as an instrument for the exchange of goods and items at that time, right? So they identify commodities like pack of rice. They use at that time, I think, different type of commodity. They use barley, all the necessities that are commonly perceived to have a value in the society or within their community at that time, right? And then they start to realize that this form of commodity money are quite perishable, right? So it's very difficult for you to carry from one place to another because you need a storage, right? You need to keep them in a good condition so that it will not get rotten, right? So they start to think that maybe this is not good for us, right? We need to start to think about another form of money, right? So they start to use gold and silver, right, which is quite long lasting in terms of the physical form, and it has a value within the society, right? So people what call it as value this gold and money a lot at that time, right? So they was thinking that maybe we could shift this to gold and silver at that time, right? So they use this what we call as the precious metal as money at that time. And then this is where the regulators came into the markets, right? Because remember that we have seen earlier the evolution of the markets is getting quite complex, right? Hence, you need some sort of regulation, right? So, because there will be a lot of misuse in terms of how people trade using gold and silver at that time. Mahmoud, can you try to mute yourself again, because I'm hearing the background noise.
I have muted it. It is
Yeah.
muted.
No, it's not at the moment. Your another account.
Yes, I have muted it also. But it's not me, maybe.
It's not now. Can you try? Yeah. Right. All right. So people. So at that time, regulator detach the money or the instrument that used for transaction from having the physical form to what we call as the fiat money, right? From what we have seen, the paper money, right? The notes that you have, right? The note itself, it doesn't have much value, right? But because it's backed by the regulators, right? Because if you want to buy something, or if you want to transact any goods or item using this paper fiat money, you know that there will be some other party who will accept this money later on, because basically it has a value, because it's deemed and guaranteed by the regulators, right, at that time. So we have seen the adoption of this paper or fiat money at that time. So people don't. So the value of the money at that time was detached entirely from the gold and silver, right? And of course, there was a lot of criticism at that time, and even until now, in terms of whether the legitimacy of this fiat money, whether we will be in a good hand if we still using the precious metal currency, or any other form of alternative, right? And as the electronic and digital or IT evolution at that time, then people were using this credit card, debit card, right, where you don't have to carry cash or paper with you, the paper currency with you. People are start getting lazy nowadays, right? Even now, they don't want to use the card anymore, right? You can use your phone, your mobile phone is everything for you now, right? You can use the QR pay codes or whatnot. So people are getting more efficient in terms of their technological use, how they transact or how they do transaction with others, right? And again, they were detached. We were far away from further away from the commodity money or the gold and silver currency at that time, right? And then we have this digital asset coming in, right, as well. We have the cryptocurrency, right? We have a Bitcoin. Those are very complex. Right? To be honest with you, I don't even understand what they are talking about, right? Sometimes. And then some people claim they understand, but they don't actually, right? Even if you look at the debate now, right, whether we should embrace this, whether the central bank should embrace this digital form of asset, right, whether they should recognize this, whether they should give a legal tender to these cryptocurrencies and whatnot, right? Because basically people are clueless about this, right? When people are clueless about this, I'm talking about the public, the masses public, right? When people are clueless about the money, the form of money, right, it can create manipulation in the markets, right? Because only certain group of people who are very knowledgeable, who have the expertise of this, how cryptocurrency works, will will be manipulating over other people who have a limited knowledge about it, right? So that's the reason I think the central banks are still, be careful about recognizing these crypto currencies, right? Only certain countries have done that, but soon I think they will have to embrace this, right? Because people are becoming more advanced and advanced, and people the way, because basically you have to realize here the money has been evolved throughout the time, because we as human, as the user of the money, has evolved as well, right? The way that people do trade now is different from those people in 80s or 60s, right? We are totally different people with different way of doing business, right? We are different in terms of how we interact with others, right? So so they have no choice other than to accept this kind of evolution as well, even in terms of money and currencies, right? And you can see as well, I mean, the discussion also concerned about the evolution in terms of the function of the money and the purpose that they have as well, right? So back then, perhaps people use money for the sake of buying items only, right? But now people use money for other sake of for totally different reason, right? You will see in the towards the end of our discussion, where you can see that people needs this kind of money and other form of financial instrument to basically to transfer the risk or the exposure to certain industry that they have to others, right? In order to protect themselves or to make a profit out of it, right? So you will see that there's an evolution in that sense as well, right? In terms of how people use the money, right? Any questions so far that, or any things that you want to contribute?
Yes, I have a question.
Yeah.
About this barter system on commodity money. What's the main difference?
The difference between what? Barter?
The barter system and commodity money.
All right. So the barter system, let's say I put you in the let's go back to the ancient, those days, ancient time, using a time travel or whatever you have, right? So let's say, for example, you in one community, right? So you have 3 people live in a village, right?
Yes.
So you basically have a different business activities, right? So basically you have one farmers, right? And one is a fisherman, right? And one is basically I don't know, maybe a miner, for example, right? Gold miner, right? So they need each other in terms of, in terms of having the necessities, right? That you need rice, you need foods to sustain your life, right? So they are become an ecosystem by themselves, right? Where they trade among each other, right? But at that time, when the barter system was present, is that they don't have a common instrument where they can use it to exchange the item between them, right? So what they do is basically they exchange the good and item among themselves, right?
Yes, the means of exchange.
As the mean of exchange, right? They just change the item like that, right, among each other,
The
right?
bushman will give to the miner, and the miner
yeah. So you can see that there are different. If you can put a different currency here, let's say if you want to change a chicken with a fish, right? So you have a different quantity here, right? One price tag here. We call it's a price tag here, right? Okay. And then you have another situation where you want to exchange fish with, let's say, minerals, right? You have another price tag here, right?
Yes.
So for a multiple transaction here, you require a multiple price tag, right? You get what I mean, right?
Yeah.
But let's move a bit throughout the years, right, where we have those common commodities. Let's say barley, you have barley here, right? Or you have, let's say, move a bit forward, you have gold or silver here, right? So you can basically have the gold that will what we call as will denotes the value of each item that has been transacted among these three party, right? So meaning that you don't need individual price tag for different pairs of items and goods, right? You can use the value of the gold itself as a medium for you to exchange good and services at that time, right? So so that's how the currency system actually help people to improve their daily life in terms of getting more efficient in terms of doing the transaction.
Yes, I get it now.
All right. Okay. Okay. Right. So can I move? All right. Anyone I want to add? No. Right. Yeah. So other than money, where people store their value or their wealth, there are other form of or there are other avenues that they can do so, right? This is what we have seen the emergence of
Doctor,
yeah. Yep. Go on.
like, what was the main cause of going from gold or silver to fiat money?
What is the main reason for moving from
Yeah.
gold to silver? Right. So again, people are becoming more efficient, right? It's not wise for you to carry this metal are quite heavy, and then you need a storage at that time. If you look at if you read the history of how financial markets work at the time, right? So let's say this miner, right? Gold miner and whatnots, right? So they have the place where they mine gold, right? And also you have they are traders as well. They were traders as well. They exchange, they buy goods and they sell to others at that time as well, right? So within their locality, they have like for, I'm not sure whether it's a company or is it let's say it's an institution, right? Where provide a service of keeping the storage for the gold and silver, right? So where they mine, they have their gold collected, and then they deposited their gold in the vaults, right? The gold vaults here, right? But you realize that these people are moving one place to another because they are basically a traders as well, right? So they go from one place to another's, right? So where they need to do a transaction here to these places, right? So it's not efficient for them to carry around this gold, right? So what they do at that time is that these miners or these traders, basically they ask this service this gold vault service provider to issue them a certificates, right? So they come to the shop, the vault shop, and then asking like, can you issue me a sort of paper or certificate saying that I have deposited certain amount of money at your place, right? So that I can use the money when I travel to another places, right? If I want to buy goods or want to buy a certain item there, so that I can use this piece of paper, right, as a proof that I have certain wealth in terms of gold somewhere else, back at my place, right? So that I can buy your goods and item, and then I will give you these certificates, right? So later on, you can use this, the seller can use these certificates to claim back the gold that they have been deposited around. So this is just one transaction, right? And this certificate will go around and around in the across the place, right? So that's basically, if you're asking me about the history of how the idea or the what we call as the notion of people moving from gold and silver to paper money is because of they are becoming a traders right now, because they need they need to bring around their wealth in order for them to buy goods and item and trade among themselves, right? So people becoming more efficient at that time. Is it clear?
Yeah,
Milo?
it's clear. Yeah,
All right.
it's clear.
Okay. So of course there are other reasons at that time. If you read they have this story about Bretton Woods agreement, right? Of course there are other explanation on that, right? You can visit that reading as well, right? So that's basically the idea that we would perceive here in terms of how money evolve, right? Because our people becoming more efficient in terms of doing their trades, and then they need different form of money to do the transaction, right? So that's basically about it. Right? And as people become more efficient and become more sophisticated in terms of the way they do their business, so people were demanding about having other form of asset as well, right? Not just in form of physical money, right? Or in form of currency, right? So they want to have something that can give returns as well, right? So they can store their wealth, right? They can store, and then at the same time they can generate some return as well. So that's where you see the emergence of different financial asset, right? We will look at this form of financial asset in the next class, I think, very soon. But as for now, you need to know there are two main purpose of owning this or for people to purchase this financial instrument. First is because they want to use it to channel resources from one party to another party, right? Because in the market, there's always this kind of discrepancy. What I mean is that there's always one party who have the expertise in terms of how to make more money, right? In terms of making a business out of it, right? But they are limited in the sense of they don't have enough capital, right? They don't have enough resources, right? And there's always another part of the economy where people have the access to the capital, right? They have more resources, but they basically don't have the business avenue where they can, grow the money, right? So the job of financial instrument is basically to merge or to link these two group of people, right? So that they can share the return, right? That is basically what we are trying to push forward in the Islamic banking and finance, right? Where people are dealing or people are engaging in the real economic sectors, right? Rather than having a speculative financial activities, right? So that's basically the reason why they need this sort of financial instrument. You will see the detail more about this financial instrument in the next session, right? And the second reason is basically people are trying to transfer the exposure that they have to certain industry, right? So, for example, if you are a milk producer, right, you produce milk every year, right? And then your company is basically exposed to the fluctuation of the commodity price, right? The milk price that is traded in the markets, right? So if you want to safeguard your business exposure to those price volatility, right, you will find another party, right, that can bear those kind of risks, right? So you will be so that you will limit your exposure to certain level, right? So you will see that there is a kind of financial instrument that fit this purpose as well, where people are transferring risk from one party to another party, right? The common instrument that we have as a common people in the street is what we have in terms of the instrument policy that we pay monthly, right? So that kind of financial instrument as well, right? If you think about it, right? There are different way that we can classify or we can categorize this financial instrument, right? Whether we can, describe it as a primary instrument, right? Where you've seen in terms of loans, financing, where you deposit your money at the banks, right? So that's basically the primary financial instrument that but basically most people have it, right? This derivative is what I was talking about, the transfer of the risk just now, right? You have futures, options, swaps. You will look at this in the next couple of weeks, right? And then you have a financial instrument that is hybrid in nature, where they combine this both primary and derivative in one financial products, right? Excuse me if I'm talking too much. So yeah, so that's just a bit introduction about financial instrument. Anyone, if you want to have a question, you have any questions so far?
Yeah, doctor, like financial instruments basically are banks, right?
Sorry, come again.
I said basically financial instruments are banks, right?
No, what we're talking about here is basically the product and services provided by banks, right? So let's say you have.
Okay.
All right, I think you understand the situation, right? The instrument here is basically the product and services that have been traded in the markets, right? Okay, it's not the institution. Institution we will see now, right? No, after this, right? So
okay. It's what is being done to banks or on banks.
Yeah. So for example, if in the case of mortgage right now, right, in the economic sector, where is that? All right. So there's a economic person here who need the capital to buy the houses, right? So what banks do basically, they will issue the mortgages or the loan, right? So these mortgages and loan is basically a transfer of resources, right, from one party to another party, right? So this is an example of instrument, right? The one basic example of instrument, right? The financial instrument can be more complex than this, just loans or mortgages, right? But for now, I think let's just limit our discussion to that, right? Okay.
Yes.
It's good so far. All right. Okay.
Yeah, it's good.
Okay. So of course, when you have these different people with different needs, right? And then you have a different financial instrument offered and traded, you need a kind of place for these two, where these two parties will meet, and then they will basically do the transaction, right? This is what we call as the financial markets, right? There are two common or two main function of financial markets, right? The first one is basically for price discovery, right? And of course, the other one is basically for the transfer of resources, and also the what we call as the transfer of risk, right? So let me explain to you the first one, the price risk, about the price discovery, right? Because if let's say if there are two group of people who are strange to one another, right? You don't know about their background, right? But you decided to do a transaction with one another, right? So what you will do is basically you you require the information about the other party as much as you can, right? So that you know that there is certain possibility that the other party will not meet the obligation when they enter into the financial negotiation or financial contracts, right? So this is the function of where financial market will serve both party, right? Because having the access to financial markets, I can, as a capital provider, I can go to the market saying that I have this certain amount of cash. So who would like to, take it from me and then give me some returns in the future, right? And the same thing to other party, right? People who need the cash will basically come into the market saying that I need certain amount of cash, but I have some business opportunity that will grow up the money, right? So please give me some capital there, right? So they will issue like certificates like bonds or commons borrowings that you will see, right? So when these two party meets, right? What they will do is they do a transaction from one time to another time, right? So frequently they will do transaction, right? As they go along with doing the transaction, they are becoming more known to one another, right? So they understand the other party better across a period of time when they do the negotiation, right? And then you will see that as they do that, right, the financial markets is becoming more efficient in terms of the cost, right? The cost is getting much lower as compared to at that time when they first deal with one another, right? Across the time, you will see that the cost of a transaction will reduce significantly among these two parties, right? Hence, they will negotiate price at that time, right? So this is what we call as the price discovery, the function of the markets where they where two different needs met with one another, so they start to negotiate and then they will decide on the price, right? How much demand, how much, for example, the bonds or the borrowings that is valued in the market. It's basically, if you think about that, it's basically just a negotiation between two different parties who need a different resources and also business opportunity at that time, right? So if I can simplify how the financial market works, is like that, right? So that's in terms of price discovery, and then of course, as I mentioned earlier, in terms of the function of the financial instrument, this is what the financial markets for these people, right? Where they can transfer the resources from one party to another, right? Basically, how we classify financial markets, we can classify whether it's a debt-based market, right? Debt-based markets means that they borrow from one another, right? So if I give you resources now, it will increase your future obligation in terms of you need to repay me with that initial capital and also some return as well, right? So that's basically the debt markets are all about, right? You will see a different type of instrument. You have bond, mortgages, and other type of debt-based instrument as well, right? And the second category of the financial market, we have the equity markets, right? This is where the company listed their shares, right? Basically, what they're selling is basically the ownership of the company, right? They're inviting the public to give more capital to them so that they can run their business operation, and in the future these stock prices will go up and then they can get the capital appreciation and also some returns in terms of what we call as in terms of shares, right? And we can describe financial market into primary and also secondary markets. Primary is meaning that something that happened at the initial stage, right? For example, if the company decided to to list their company, their shares in the stock market at the first time, right? So they engage with this called as investment banks, and then the job of this investment bank is basically to find the parties who are interested to buy the shares of the company, right? So they where they issues what we call as the initial public offering, right? IPOs. I think you heard this before this, right? So that's basically the primary markets, right? So if you see the discussion in about financial markets, they are very much concerned about secondary markets, right? Let me use this, right, because it's very limited space left, right? So you have for financial markets, you have primary markets, and you have secondary markets, right? Primary markets, the function is very easy. Like I mentioned earlier, is to help the company to issue shares or bond at the first time, right? So the discussion are quite limited in that sense, right? But more discussion in finance pertains to secondary markets, where people need a type of market where they can trade the financial instrument that they have purchased in the primary markets. Let's say they purchase shares or bonds here, right? So the investors who purchase this bond can go to the secondary markets, because basically at that time he need the liquidity, he need cash, he need to cash out from the markets. So there is a secondary markets available for him to sell those instrument, for him to sell those financial instrument, so that he can get the money, right? So this financial instrument that has been issued earlier, right, will be traded like so many times, right, from one party to another party. So that's basically the function of secondary markets. Is basically to serve the liquidity, right? The liquidity needs in the markets, right? Clear about the difference between these two, primary and secondary? We will see this more later when we discuss. This is just introduction. All right. So you also have an exchange for shares and other commodities, right, where you can go as a common people, you can go into this exchange, whether it's a physical exchange or it's a virtual exchange through your mobile apps and whatnot, right? Where you can buy shares, you can buy different commodities there, and get a return out of it, right? And how we classify that market is we can divide that market into money markets that is very short term in nature, less than 12 months, less than a year, that give you an instant returns out of it. This is what we call as the money markets. We'll go through more about this later. Yeah? And then something that is long-term in nature, long-term investment is what we call them as the capital, or what we term as the capital market. Right? There are there's a two distinction in the debt markets, which consists of money markets and also capital markets. Right? This is just about the terms that terminology that you need to be familiar with, right?
Yes.
All right. Okay.
As if it shows that the debt and the money market, it's the same thing.
Yeah. Yeah. So that's how you classify, right? So you have debt market versus equity market, right? Equity is all about shares, right? And then debts, you have a bond, you have other type of debt instrument, you have syndicated loan and whatnot. You'll see this when you have loans and what, right? So how we classify the debt market into two is in the money markets, and also the other one is the capital market, right?
Yes.
We will look at this. This is short term, less than 12 months, and this is on long term in nature, right?
Yes.
Okay.
Yes. Okay.
All right. So I just introduced to you the terminology that we use, right? we look at the mechanism of each of these market later when we discuss a bit more detail in the next topics. Okay, I think can we stop here first for Maghrib prayer and then we come back? Is it okay? We continue the rest. I mean, it's not that much, I think, left.
Okay, doctor. Yes. Thank
Okay, all right. Let me stop the recording. And then I will see you at what time just now? 8, right? I'll see you at 8. And then we finish at 9, inshallah. So you can leave the session and then there will be another session after this. No problem. Right? I'll see you inshallah after this.